accounting. It could be mercantile basis of accounting, or it could be on the cash basis of accounting. If an SSC follows a particular system of accounting, then changes it without intimation to the Deputy Commissioner of Taxes, or if a particular system in one income year is changed by the SSC himself, in that case, his accounts could be rejected by the Deputy Commissioner of Taxes. So this is the major issue or major reason why accounts could be rejected. But there might be some other reasons why accounts could be rejected. Maybe the SSC produces a statement of accounts in support of the income he has shown in the return. And this statement of account just the summary of the accounts he has maintained, or some of the major figures like sale, gross profit, then purchases, closing stock, and then the overhead, that is administrative overhead, selling overhead, marketing overhead, etc. And net profit is arrived at. Such a summarized form of a statement of account is shown, but there is nothing in detail in support of the statement of account submitted by the SSC. That means whenever he was asked to produce sale vouchers, whenever he was asked to submit the purchase vouchers, or he was asked to produce the inventory book in order to see the quantity of the inventory he purchased and the inventory he sold out, and the remaining inventory he has in his hand. And also about the bank charges, also the interest given to the bank, or the liability that has been paid off, the amount from which the SSC could settle the liability, something like that. So if the SSC was asked to produce any of the documents or evidences required by the SSC, and if the DCT is of the opinion that the accounts were not maintained in a proper way, however, the summarized form of statement of account was just the estimate. In that case, the Deputy Commissioner of Taxes can reject the books of accounts of the SSC. Books of accounts means the statement of account that has been produced would be rejected. And in that circumstances, the DCT can estimate the sale and also estimate the GP, and then he can estimate the overhead, and later on he can come to the decision of calculating the net profit. In this case, the DCT can, based on the previous record, that means what amount of sale was estimated in the previous year in case of this SSC, and what percentage of gross profit was also calculated in this case. So if the percentage of GP is 15%, and it is followed by the DCT this year as well, it will be well accepted. And the sale that was estimated in the previous year at 5 crores, and in this year, if the DCT estimates the sale at 5 crore or 5 crore 50 lakhs, yes, that is also reasonable and justified. So in that case, the SSC, the DCT would be able to estimate the income of the SSC, but the statement of account that was produced by the SSC before the Deputy Commissioner of Taxes could have been rejected by him. And even the SSC, if he prefers an appeal against the order of the Deputy Commissioner of Taxes, it won't have any validity in the eye of law in the court of the Appellate Joint Commissioner or Appellate Additional Commissioner of Taxes. So the action taken by the DCT will stand valid. And again, sometimes you will see that accounts are rejected partially, not fully. When a part of the sale or part of the purchase or inventory book is not maintained by the SSE, but some other accounts are maintained, of course. In that case, partial rejection of the accounts could be made. So let us suppose that the SSE has maintained the sale book, maintained inventory book, the direct expenditure or expenses have been housed and verifiable. In that circumstance, the Deputy Commissioner of Taxes finds out that purchase was not fully housed and verifiable. In that circumstances, the DCT can just add a certain percentage of the purchase to his profit, because of the reason that there is a possibility of showing the purchases at an inflated figure, since the purchase is not fully housed and verifiable. It means that purchase has been shown at a figure, but there is a possibility that that figure could have been inflated a little bit. Because if the purchase figure is inflated, it means the profit would be less. That means gross profit would be less. Ultimately, the net profit would also be less. So that's why a certain percentage of purchase could be added to the income, maybe 5%, 7%, or whatever. Similarly, when the sale is not fully housed and verifiable, in that case, the DCT can reconstruct the sale. If others are okay, that means the purchase is housed and verifiable, inventory book has been fully maintained. So only problem is with the sale, because sale is not fully housed and verifiable, but it is housed and verifiable. However, a certain percentage of sale is not fully housed and verifiable. In that case, the DCT can reconstruct the sale as per the Dandekar formula. So reconstruction of sale could be made on the basis like the sale and the GP could be taken into consideration, and the desired GP rate could also be estimated, or it could be on the basis of the previous record. So whenever sale is shown and GP has been shown, the GP could be deducted from the sale, then you can arrive at the cost of goods sold. So when you arrive at the cost of goods sold, in that case, you have to take into account the desired GP rate. That means you can divide the cost of goods sold by 100% minus desired GP rate. So if the GP rate is 20%, so the cost of goods sold has to be divided by 80% or 0.8. So if you divide the cost of goods sold by 0.8, in that case you can have the reconstructed sale. And when you get the reconstructed sale, you can deduct the shown sale by the SSE from the reconstructed sale, and there would be a difference, and that difference is to be added to the profit. So that is a way how you can reject partially the books of accounts and can estimate or reconstruct the sale or purchase, whatever it is, in special circumstances. Then come to the question number 12, whether entertainment allowance can be given in case of loss. So generally, how the entertainment expenditure is allowed by the Deputy Commissioner of Taxes. This is, you know it very well, under Rule 65, entertainment allowance is allowed by the DCT. The expenditure which is incurred by the SSC is not fully allowed. So it is allowed on the basis of that rule, and it's allowed in 2 phases, maybe, depending on the sale or depending on the income. So whenever it depends on the income, you have to earn a profit or earn an income. So sometimes you will see the SSC which has incurred a loss. That means the books of accounts have shown a net loss from the profit and loss account. So it indicates the SSC could not make a profit, but he is claiming entertainment expenditure. But that is a genuine case. Genuine case means entertainment has been made or entertainment has been offered. This is for sure, but you might not have earned a profit. That's a different issue. Whenever you have a regular expenditure, you have to do the expenditure. You have to incur the expenditure. But ultimately, whether you will be earning a profit or you will incur a loss, that is different issue. Now the question is, sometimes you will see that the Deputy Commissioner of Taxes are not allowing entertainment expenditure in case the company or the concerned person has made no profit or has made a loss. So whether this is right in the eye of law. But the decision in this case is that it is not justified, because the business might have loss, the business might have profit. There is no certainty that every business will make a profit. And hence, if you have to allow the entertainment expenditure on the basis of the income, you have to go to the definition of income. What the definition of income says. You have to go to section 2. So what the definition of income says, let us see. So section 2, subsection 34. The definition of income is given here. So the definition of income is an inclusive income. That means it is not absolute. So it includes any income from whatever source derived, chargeable to tax under any provision of this ordinance. So it could be, the income could be income, it could be receipt, it could be profit, it could be gain, something like that, which is chargeable to tax. And clause B says, any amount which is subject to collection or deduction of tax at source under any provision of this ordinance, when tax is collected at source, maybe for any income or for any receipt, etc. So in that case also it will be treated as income. And clause C says any loss of such income, profits or gain. So any loss of such income, profits or gains, it means that the income could be negative income. So if it is negative income, it means it is loss. So whenever there is a loss, it is also treated as income. It also falls under the definition of income. So if the loss is part of the income or falls under the definition of income, definitely entertainment expenditure or entertainment allowance could be allowed even when the SSC incurs a loss or makes a negative income or makes a loss of the business. So in that case also, it is decided by the tribunal that even the business incurs a loss, it is entitled to having the benefit of entertainment allowance. And that has to be provided by the Deputy Commissioner of Taxes at the time of assessment of the income of the ACC. So SSC can claim and can have the allowance in the assessment order. Okay, then number 13. When assessment or reassessment becomes barred by limitation of time. When assessment becomes barred by limitation of time, or reassessment becomes barred by limitation of time, of course. Assessment completed under section 83(2) on 3691 for the assessment year 1988-1989. The SSC filed appeal to the Commissioner of Taxes Appeals against this assessment. The Commissioner of Taxes Appeals disposed of the appeal under section 156 on 10/3/1993. The DCT did not revise the assessment pursuant to the Commissioner of Taxes Appeals order in time as stipulated in section 94(3), but went on second appeal to the tribunal against Commissioner of Taxes Appeals order. The tribunal disposed of the appeal on 5/4/1995. No stand was taken by the SSC before the tribunal that as the DCT did not revise the assessment pursuant to Commissioner of Taxes Appeals order, it has become barred by limitation of time. So it's very natural that the DCT, when receives the appellate order from the appellate joint commissioner or from the Commissioner of Taxes Appeals, he has to revise the assessment order under section 156. That means whenever assessment was completed under section 83(2), he has to revise it, and it has to be mentioned in the assessment order that assessment is revised under section 83(2)/section 156. So in that way, the DCT has to give effect to the appellate order given by the appellate authority. So within 1 month's time of receipt of the appellate order, he has to complete it. And then from the completion of the revised assessment, he has to send it to the SSC within 1 month's time. Okay, but here the SSC, the DCT did not complete the assessment. That means the revised assessment. But what he did, he actually preferred the second appeal to the tribunal against the order of the Commissioner of Taxes Appeals. So, pursuant to the tribunal's order under section 159, dated 5/4/1995, the DCT revised assessment in time. The SSC went on appeal to the Commissioner of Taxes Appeals, holding that this revised assessment is illegal, as no assessment was made pursuant to Commissioner of Taxes Appeals order dated 10/3/1993 under section 156. Being unsuccessful at Commissioner of Taxes Appeals stage, the SSC filed second appeal to the tribunal, holding that the Commissioner of Taxes Appeals was not justified in upholding the DCT's revised assessment, as the DCT failed to revise assessment pursuant to Commissioner of Taxes Appeals order on 10/3/1993. The point for discussion before the tribunal this time was whether the reassessment made by the DCT pursuant to the tribunal's order dated 5/4/1995 is maintainable in law in view of section 94(3). As the DCT first failed to revise the assessment pursuant to city appeals order dated 10/3/1993. So the fact is that the DCT should have revised the assessment first under section 156 when he received the order from the appellate authority, that means the Commissioner of Taxes Appeals, but he did not do it. Rather, what he did, he preferred a second appeal to the tribunal, and he tried to justify that the Commissioner of Taxes Appeal was not justified in upholding the, Commissioner of Taxes Appeals was not justified in his decision. So that's why he preferred the second appeal to the tribunal, and the tribunal heard the case. And after hearing the case, the tribunal gave a decision. And when the DCT received that decision from the tribunal, he immediately revised the assessment order under section 159. But the question is, the DCT did not revise the assessment order under section 156, but he revised the assessment order under section 159. So the decision of the tribunal has been effective too. That means the DCT gave effect to the order given by the tribunal. In that case, the revised assessment order has become valid. It's legal in the eye of law. Although the tribunal could have taken that point at the time of hearing that the DCT could not revise the assessment order accordingly after receipt of the same from the Commissioner of Taxes Appeals. But that point was not raised before the tribunal, and the tribunal also not pinpoint that decision. But tribunal gave its decision, and the city just revised the assessment order as per the order given by the tribunal. Hence, the revised assessment order became valid, and the DCT got a fresh lease of life. That means he committed a mischief by not revising the assessment order under section 156. He could have been punished by the authority, that's the National Board of Revenue, or by the Commissioner of Taxes of his job. But since he has given effect to the order given by the tribunal, and this is the final order to be followed by the DCT as well as the SSC, and hence the DCT was relieved of the mischief. So that was the case, and you have to remember such a case in your practicing life. Practicing life means the appellate authority's decision should be followed by the Deputy Commissioner of Taxes, and later on the question arises as to whether the second appeal could be preferred or not. But if the appellate authority's decision is not given effect to, in that case the DCT has not done the right thing, and he could be responsible for misconduct, or he could be accused of misconduct. So this is all about the questions we have put in the handout. And I believe that we have discussed all the issues here. If you have any question, you can ask me. Otherwise, you can consult the income tax ordinance as per the questions or issues prepared here and given in the handout. If not, then we can stop here. And thank you very much, everybody, for your attendance. And I hope that we can again discuss some of the issues later. or in the coming classes. Thank you. Thank you and welcome.